MapMyIndia's corporate governance controversy, a deep dive. Hey y'all, welcome to Zenvest Insights, your destination to mindful wealth creation for a balanced life. What happens when a board decision shakes investor confidence and sends shockwaves across the stock market? MapMyIndia's decision to spin off its B2C business into a separate entity led to a stunning U-turn after intense backlash. But what does this mean for minority shareholders? Let's dive into this corporate roller coaster. It all started when MapMyIndia, a leader in B2B and B2B2C solutions, made a controversial announcement on the 3rd of December 2024. CEO Rohan Verma would step down to start a new venture focusing on the B2C segment, with MapMyIndia holding a 10% stake in this entity and committing rupees 35 crore through Compulsory Convertible Debentures, CCDs. Let's take a closer look at what Compulsory Convertible Debentures, CCDs, really are. In simple terms, a Compulsory Convertible Debenture, CCD, is a type of loan that a company takes, but instead of paying the lender back in cash, the company must convert this loan into shares of the company after a certain period or when specific conditions are met. In MapMyIndia's case, it works as follows. MapMyIndia planned to invest rupees 35 crore into a new company using CCDs, with terms allowing these debentures to convert into shares at a 25% discount to third-party valuation. MapMyIndia's controversial board decision to spin off its B2C business, led by ex-CEO Rohan Verma, faced intense backlash from investors over governance concerns, leading to a swift market reaction and eventual reversal. The episode highlights critical lessons in corporate governance and shareholder rights, underlining the importance of transparency and accountability in corporate decisions. The new company's CEO, who owns 90% of it, would get a favorable deal. Minority shareholders in MapMyIndia would see their stake diluted in the future when the CCD converts into equity. This setup led to accusations of shortchanging public shareholders and favoritism toward insiders. For minority investors, this looked like a way to use their money to benefit private interests. The conflict of interest arises as the new entity, 90% owned by former CEO Rohan Verma, is set to use MapMyIndia's retail brand, Mappls, an asset built with MapMyIndia's resources and shareholder investments. This move benefits the new company disproportionately while weakening MapMyIndia's competitive position in the B2C space. By granting access to this key asset, MapMyIndia dilutes its brand value and risks losing control over its growth prospects, disadvantaging its shareholders. Such decisions, favoring insiders over public stakeholders, undermine investor confidence and highlight governance concerns. The announcement claimed this move would allow the company to focus on its core strengths in B2B. But for investors, this raised a big question. Why hive off a business segment that had seen significant investment and growth? As you all would have expected, the market's reaction was swift and brutal. In just 2 trading sessions, MapMyIndia's stock fell by 10%, erasing significant market value. Prominent voices from the investment world like Ambarish Baliga and Sanjay Dutt called out the deal as a potential conflict of interest and accused the board of prioritizing private gains over public shareholder interests. Here's why this decision was problematic for minority shareholders and raised governance red flags. Rohan Verma, the outgoing CEO, held 90% stake in the new venture. Was this deal structured to benefit him disproportionately? The decision appeared rushed and poorly communicated, leaving shareholders in the dark. The rupees 35 crore investment would be funded by shareholder money, raising concerns about whether this was the best use of cash reserves. The CCD terms, offering a 25% discount to third-party valuation, could have diluted minority shareholder value in the future. Then comes the U-turn. Under mounting pressure, the board reversed its decision on December 9, 2024, announcing that it would no longer invest in the new venture. The company justified this reversal by stating its renewed focus on its profitable B2B and B2B2C segments, which make up over 99% of its revenue. The result? A quick 18% rebound in the stock price. Here are the implications for minority shareholders. While the reversal is a relief, the episode leaves several questions unanswered and lessons to be learned for minority shareholders. A decision like this erodes confidence in leadership. If the board could initially greenlight such a move, what safeguards are in place to protect shareholders in the future? Even with the U-turn, the stock saw volatility, which can hurt retail investors the most. The role of independent directors in questioning such proposals needs to be stronger to ensure shareholder interests are not sidelined. It teaches many lessons for the investors. For investors, this controversy highlights the need to monitor corporate governance closely. Here are some takeaways. Always scrutinize related party transactions and their impact on shareholder value. More on related party transactions in upcoming videos. Track how the board communicates major decisions and whether they align with the company's stated goals. Demand transparency and accountability from independent directors and management. Shareholders, your voting rights are your strongest tool to protect your interests. Use them wisely to oppose decisions that compromise transparency or harm the company's value. Active participation ensures better governance and safeguards your investments. Stay vigilant, invest smart. MapMyIndia's reversal is a win for shareholders, but it also exposes the cracks in corporate governance. What do you think? Was this U-turn enough to restore trust? Let's discuss in the comments below. And if you found this deep dive insightful, don't forget to like, share, and subscribe to stay updated on corporate stories that matter.